Picture a bakery, November, early morning. The price board behind the counter reads 200 billion for a loaf of bread. Not 200, not 200,000, 200 billion. The woman ahead of you pulls out a wheelbarrow. Not for groceries, for cash, enough paper currency to buy milk. By the time you reach the counter, the baker crosses out the price, writes 250 billion. The currency lost 30% of its value while you stood in line for 12 minutes. This isn't fiction. This was Berlin, 1923, the Weimar Republic, and it's happened again. Venezuela, Zimbabwe, Lebanon, Turkey. The pattern repeats. The currency dies. The people holding the wrong assets lose everything. The people holding the right assets survive. But here's what nobody tells you. The assets that survive aren't the ones you'd expect. They're not the ones your financial advisor recommends. They're not the ones that look safe on a prospectus. They're the ones that have survived every single monetary collapse in recorded history. And the financial system doesn't want you to know what they are. I am Ken Au. Welcome to the Vault. Today we dissect the currency collapse playbook spanning 100 years. And by the end, you'll know the 5 asset classes that survived when empires burned. Let me show you the pattern, because currency collapse isn't random. It's not unpredictable. It follows a mathematical sequence, every single time. Stage 1. The government spends more than it collects. Deficits become structural, not temporary, not emergency measures. Permanent overspending baked into the system. Stage 2. It prints money to cover the gap. Central banks monetize the debt. They create currency out of nothing to buy government bonds. The monetary base expands. Stage 3. The currency starts losing purchasing power, not all at once, slowly at first. Prices rise, people notice, but the official narrative says it's temporary, transitory, supply chain issues, external factors, anything but the truth. Stage 4. People flee to alternatives. They start converting their savings into assets that can't be debased. Gold, foreign currency, real estate, anything that isn't paper promises from a failing state. Stage 5. Complete collapse. The currency becomes worthless. Overnight or over months, doesn't matter. The outcome is the same. Total wipeout. Weimar Germany went from 320 marks per dollar in mid-1922 to 4.2 trillion marks per dollar by November 1923. That's a 98% loss in 18 months. Venezuela's bolivar went from 10 per dollar to over 1 million per dollar in a decade. Zimbabwe printed a $100 trillion note. Lebanon's pound collapsed from 1,500 per dollar to 89,000 in 4 years. Same pattern, same stages, same outcome. This is where the system starts leaking. Now let me show you what survived, because in every collapse, 5 asset classes protected wealth, not speculation, historical fact, verified across centuries, across continents, across political systems. Asset 1, the most obvious, the one most people still don't own, precious metals, gold and silver, the assets governments can't print, the assets central banks can't debase. Here's the brutal math. During the Weimar collapse, if you held paper marks, you lost everything. 100%, total wipeout. If you held gold, you maintained purchasing power entirely. An ounce of gold bought you the same basket of goods before, during, and after the hyperinflation. The currency changed, gold didn't. Same pattern in Zimbabwe. When Mugabe's regime printed the 100 trillion note, anyone holding gold was protected. Same in Venezuela. While bolivars became worthless, gold retained value. Same in Lebanon, same in Turkey, and we're seeing it right now. Late 2024 data shows gold deposit accounts at Turkish banks surged from 1.36 trillion lira to 2.72 trillion lira in a single quarter. That's a doubling in 3 months. Why? Because Turks see the pattern. Runaway inflation, currency debasement, and they're fleeing to the only asset that survived every collapse in human history. Here's what gold critics miss. Gold doesn't need to do anything. It doesn't need earnings. It doesn't need dividends. It doesn't need innovation. Its entire function is to not be debased. When the supply of fiat currency explodes, the purchasing power of each unit collapses. Gold supply can't be arbitrarily expanded, so it becomes relatively more valuable by default. During 2008, gold crashed initially, fell hard as liquidity froze, but once the dust settled, it rose 166% in less than 3 years. Silver did even better, 448%. During the 1970s stagflation, gold fell almost 50% mid-decade, then bottomed in 1976 and surged 440% over the next 3 years. Pattern recognition, verified, undeniable. The mechanism is brutally simple. Precious metals are insurance against monetary system failure, not speculation. Insurance. You hold them because they do nothing except preserve purchasing power when everything else burns. Asset 2. Foreign hard currencies. When your domestic currency is dying, the escape valve is holding someone else's stable money. Let me take you to Beirut. October 2019. You're a nurse. You've saved $50,000 over a decade. The Lebanese pound is pegged at 1,507 per dollar, has been since 1997, rock solid for 22 years. Then the peg breaks. August 2019 black market rate hits 1,600. April 2020, 3,000. March 2021, 14,000. By 2023, the official rate is 89,000 per dollar. Your $50,000 in pound-denominated savings is now worth $1,000. You lost 98% of your purchasing power while the nominal number in your account stayed the same. But here's what changes everything. Your colleague, another nurse, kept her savings in US dollars, physically, in cash, outside the banking system. She maintained 100% of her purchasing power, not because the dollar was magical, she could have used Swiss francs or euros, but because she held a currency that wasn't collapsing. This pattern repeats everywhere. Zimbabwe. The economy dollarized itself before the government made it official. People abandoned the Zimbabwe dollar entirely and started using US dollars for transactions. Ecuador did the same in 2000. El Salvador in 2001. Panama has been dollarized since 1904. Venezuela right now. Venezuelans use dollars for major purchases, even though the bolivar is still technically legal tender. Argentina, you buy property in dollars, not pesos. Cambodia, ATMs dispense US dollars, not reals. This isn't policy choice. This is survival mechanism. When domestic currency fails, rational people switch to stable foreign currency. The government can mandate all it wants. People vote with their wallets. The lesson is clear. Access to foreign currency during a crisis is complete protection. A person holding dollars during the Lebanese collapse maintained their wealth. A person holding pounds lost 98%. That's not market volatility. That's the difference between survival and annihilation. Asset 3. This is counterintuitive. This separates people who understand currency collapse from those who don't. Productive equities, stocks, ownership in real companies with real assets. Here's what blows people's minds. Venezuela's stock market rose over 3,400% in 2024. The Caracas Stock Exchange surged from 2,082 points to over 6,000 in 9 trading days in January 2026. Individual stocks went parabolic. Mercantil Servicios Financieros up 200%, CAN TV up 219%, Banesco up 171%. You might think, wait, the economy's collapsing and stocks are skyrocketing. That makes no sense. Wrong. It makes perfect sense once you understand what stocks are. A stock isn't a piece of paper. It's ownership in real assets, factories, equipment, inventory, land. When currency collapses, the nominal price of those assets rises to match inflation because the assets themselves haven't disappeared. Imagine a Venezuelan manufacturing company worth $100 million in real productive capacity. When the exchange rate goes from 10 bolivars per dollar to 30 bolivars per dollar, the stock price rises from 1 billion bolivars to 3 billion bolivars. Not because the company got more valuable, but because it takes more bolivars to equal the same dollar amount. But here's the critical distinction most people miss. Not all stocks survive equally. Only companies with revenue streams diversified away from the collapsing economy maintain real value. A company earning 100% of revenue in bolivars sees its real profitability collapse even as its nominal stock price rises, because it has to convert worthless bolivars back to dollars to buy foreign inputs. Its margins are crushed. Conversely, a company that exports 50% of production receives dollar revenues directly. Its bolivar costs decline in real terms while dollar revenues stay stable. Real profitability improves during devaluation. For shareholders, this becomes an actual inflation hedge. Research on Latin American crises confirms this. Mexico's peso crisis of 1994, Asia's meltdown of 1998. Direct investors operating manufacturing facilities that could redirect sales from local markets to export markets survived and thrived. Other investment forms plummeted. The key was export capability. So the lesson. Productive equities with international revenue streams are not just survivors, they're beneficiaries of currency collapse. But domestic-only companies, they burn with the currency. Asset 4. Consumables and barter goods. When the formal monetary system fails completely, economic activity doesn't stop. It reorganizes around different media of exchange. Post-World War II Germany, the Reichsmark was so worthless it was effectively abandoned. People traded goods for cigarettes, coal, potatoes. Cigarettes became particularly prominent as a temporary currency. American soldiers bought cigarettes from army exchange stores for pennies and traded them with Germans for goods and services worth exponentially more. Why cigarettes? Standardized, easily divisible, non-perishable, lightweight, widely accepted. They had all the properties of money except one. A government didn't issue them. Black markets near train stations in big German cities operated 24/7, trading everything from railway tickets to forged documents with cigarettes as the medium of exchange. Here's the economic proof. When large backlogs of Red Cross packages arrived at POW camps, sometimes injecting hundreds of thousands of cigarettes into the camp's money supply at once, it caused inflation in cigarette prices. Same mechanism as fiat currency expansion. More cigarettes chasing the same goods equals higher cigarette prices. Fast forward to Venezuela 2018. As the bolivar became worthless, Venezuelans engaged in barter. Fishermen traded their catch for flour just to feed their kids. Items that held value: medical supplies, food, water, fuel, batteries, lighter fluid, basic tools. Anything with immediate consumption value or enabling essential functions. During supply chain disruptions, even toilet paper, soap, and wet wipes became valuable. Not for comfort, for health. Staying clean prevented infection spread during systemic failure. But here's the limitation. Consumables are consumed. They can't serve as long-term stores of value. You can't build a portfolio on aspirin and batteries. They're tactical, not strategic, the optimal allocation. A small portion in physical necessities for immediate exchange value during acute crisis phases, but the bulk of wealth and assets that don't evaporate when used. Asset 5, agricultural land, the immobile store of value that produces the one thing humans can't live without: food. During the Great Depression, farmers had survival advantages over urban dwellers that were stark and undeniable. Farm families raised gardens, canned fruit from orchards, had milk and cream from dairy cattle, chickens for meat and eggs. They could do without new clothing and consumer goods, but they faced one brutal constraint. They still had to pay taxes and debts to banks and cash. This dynamic plays out in every modern collapse. Venezuela, those owning agricultural land, maintained capacity to produce food regardless of currency fluctuations. Those owning urban commercial real estate faced tenants who couldn't pay rent in any meaningful terms. Land produces calories. Urban real estate produces rent denominated in collapsing currency. Calories win, but agricultural land has severe vulnerabilities. First, it's utterly illiquid. You cannot move it. You cannot quickly sell it. If political circumstances deteriorate and ownership becomes unsafe, you're stuck. Zimbabwe 2000. Mugabe's land seizure program simply revoked commercial farmers' property rights by decree. Farms were redistributed without compensation. Sophisticated operations were destroyed. Agricultural output collapsed 60% over a decade. The farm's aggregate value declined by 75% between 2000 and 2001 alone. Second vulnerability: taxation. A person holding urban commercial real estate in a collapsing currency may be forced to sell at a fraction of previous value just to raise cash for property taxes. Land cannot hide. Governments know where it is and can tax it into oblivion. Third, agricultural land that produces export crops is superior to land producing only for domestic consumption. Export crops sell for stable currency. Domestic crops sell for collapsing local currency. So the strategy: own land that's either productive and capable of generating export revenue located outside the jurisdiction of the collapsing currency, or held through a corporate structure that protects against seizure or direct taxation. Agricultural land maintains fundamental value through its capacity to produce food, but it's less liquid and more vulnerable to government interference than precious metals or portable equities. Now let's talk about what goes to zero, because understanding what fails is just as important as knowing what survives. Asset Class 1, with a bullet. Fixed income securities denominated in the collapsing currency. Bonds, treasury notes. Anything where you're a creditor to a failing state. Weimar Germany. Bondholders who held government bonds in marks saw their investment become worthless as the marks used to pay interest and principal evaporated. Argentina, 2001. Bondholders saw nominal value cut by 70% in debt restructuring. Even this reduced value could only be collected after years of legal disputes. The fundamental problem: fixed income securities are a claim against the collapsing currency itself. When the currency collapses, the claim becomes worthless. This isn't market failure. This is logical consequence. Asset Class 2, savings accounts in domestic currency held within failing banking systems. Lebanese deposits denominated in pounds lost more than 95% of value as the pound devalued from 2,500 per dollar to 89,000 per dollar by 2023. Bank customers who placed savings in pound deposits in 2019 retained 2% of original purchasing power by 2024. The nominal amount stayed the same. The value disappeared. History is unambiguous. Being a creditor to a failing state is the fastest route to 100% wealth destruction. This is where things get darker. Let me show you where we're seeing these warning signs right now, because pattern recognition only matters if you can identify the setup before it executes. Iraq. Financial crisis due to lack of cash liquidity. More than 70% of monetary supply is inaccessible due to banking restrictions on withdrawals. The dinar devalued from 1,190 per dollar to unofficial rates approaching 1,750. Public distrust of banks. Currency smuggling across borders. This is stage 3 behavior. Turkey. Gold deposit accounts more than doubled in a single quarter as citizens fled to precious metals. Runaway inflation. Currency debasement. This is stage 4 behavior. Currency substitution has begun. Lebanon. 98% currency collapse already executed. Banking system technically insolvent. This is stage 5, complete failure. And then there's the elephant in the room, the United States. $38 trillion in debt. Debt to GDP ratio expanding unsustainably. Interest payments on national debt now higher than military spending. The dollar's share of global foreign exchange reserves has fallen from 80% in the mid-1970s to 65% now. Same path British sterling traveled during its decline as the world's reserve currency. In 1913, Britain was the world's biggest creditor. Within 40 years, it became a net debtor, and the dollar replaced sterling. The pattern is visible if you're willing to look. This doesn't happen by accident. When you study a century of currency collapses, you start seeing something that's hidden in plain sight. The people who survive aren't lucky. They're positioned. They saw the pattern, and they acted before the collapse became obvious. In Weimar Germany, the industrialists who held physical assets thrived. The bondholders who trusted the government were wiped out. In Venezuela, the executives who moved assets offshore in 2015 maintained their wealth. The professionals who kept savings in Bolivar-denominated accounts lost everything. Someone always knows. Someone always sees it coming. The question is whether that someone is you. Let me give you the escalation loop, because once the collapse starts, these asset classes don't just preserve value. They interact, they compound, each one amplifies the next. Loop 1. Currency starts losing purchasing power. People notice inflation. They start buying gold and silver as insurance. Demand for precious metals surges. Prices rise. Loop 2. As precious metals rise, it validates the currency collapse thesis. More people flee domestic savings accounts. They convert to foreign currency. They move money offshore. Capital flight accelerates. Loop 3. Capital flight weakens the domestic currency further. Imports become more expensive. Inflation accelerates. The currency depreciates faster. This triggers more capital flight. The feedback loop intensifies. Loop 4. As inflation surges, productive equities with export revenue see their profits improve. Foreign currency revenues stay stable. Domestic costs decline in real terms. These stocks become the only way to maintain purchasing power in the domestic market. Money flows into equities. The stock market surges even as the economy collapses. Loop 5. As formal currency becomes worthless, barter systems emerge. People trade consumables, medical supplies, food, fuel. These items become informal currency. The parallel economy grows, the formal economy shrinks. Loop 6. As urban centers become unstable, people flee to rural areas. Agricultural land values surge, not because of speculation, because land produces food. And food is the one thing that always has value. Each loop feeds the next, and once the cascade starts, it doesn't stop. It accelerates. Now let me show you what this means for asset allocation, because diversification takes on a completely different meaning when you're protecting against systemic failure. A portfolio consisting entirely of equities in a single country faces catastrophic risk if that country experiences currency collapse. A portfolio consisting entirely of bonds denominated in a collapsing currency will be destroyed. A genuinely diversified portfolio includes exposure to precious metals as insurance, foreign currency assets to protect against currency-specific risk, productive equities with international revenue streams, and possibly real assets in stable jurisdictions. This isn't about being a doomsday prepper hoarding gold in a bunker. This is about recognizing that currency collapse is not a low probability tail risk. It's historical norm. The average fiat currency lasts 27 years. 99% of all currencies that have ever existed no longer exist. The question isn't if your currency will fail. The question is whether you'll have positioned yourself to survive when it does. Let me give you the open-ended warning. If this continues, if the debt keeps expanding, if the deficits stay structural, if the central banks keep monetizing government spending, the pattern suggests an outcome, not a prediction, a probability based on historical precedent. The 5 assets that survived every collapse since 1923, precious metals, foreign hard currencies, productive equities with export revenue, consumables for barter, and agricultural land. The assets that went to zero, fixed income securities in domestic currency, and savings accounts in collapsing currency. The lesson isn't to abandon domestic assets entirely. The lesson is that genuine diversification requires holding different forms of value that respond differently to monetary system failure. The contemporary warning signs in Iraq, Turkey, Lebanon suggest currency crises remain a live possibility. The US dollar remains stable, but historical record provides abundant evidence this status cannot be taken for granted indefinitely. The most prudent approach isn't to panic, it's to recognize the pattern and position accordingly. Sufficient diversification across different asset classes and jurisdictions means no single failure scenario can destroy purchasing power entirely. History has the answers. You just have to be willing to look at the autopsies before you become the next case study. The pattern is mathematical, predictable, the currency dies. The people holding paper promises lose everything. The people holding real assets survive. Stage 1, Structural deficits, stage 2. Money printing, stage 3. Purchasing power erosion, stage 4. Capital flight, stage 5. Complete collapse. We're watching multiple countries move through these stages right now. Turkey in stage 4, Lebanon in stage 5, Iraq in stage 3, and the United States showing early signs of stage 1 becoming entrenched. The signal is being sent, not by conspiracy theorists, by the data, by the debt levels, by the currency reserves shifting away from dollars, by central banks buying gold at record levels. Someone sees the pattern. The question is whether you're paying attention or whether you're standing in line at the bakery wondering how bread costs 200 billion marks. The assets that survive currency collapse aren't the ones your financial advisor recommends. They're the ones that have survived every monetary collapse in recorded history. And the financial system doesn't want you to know what they are, because if everyone understood the pattern, the capital flight would start tomorrow. By the time the mainstream media admits the currency is failing, it will already be too late. The foreign currency will be unavailable, the gold will be sold out, the productive equities with export revenue will be trading at multiples, and the people asking, why didn't anyone warn us, will be the same people who scrolled past this video. The pattern is repeating, the stages are advancing, the warning signs are everywhere. The only question is whether you'll see it coming or be caught holding worthless paper when the music stops. History doesn't repeat, but it rhymes. And right now, the rhyme sounds an awful lot like Berlin, 1923, like Caracas, 2018, like Beirut, 2021. The pattern is mathematical. The outcome is predictable. The only variable is you.